Hello, everybody. Good afternoon. Thank you for joining us on another edition of our Power Play Tuesday. My name is Andrea. I'm an IRA specialist here at Quest. Today we have a really good presentation with Chris Carsley, investing in fixed income in 2024, strengthening your portfolio with alternative strategies. Super excited about that. And we'll bring Chris up in a moment here. Before we go ahead and get started, though, if you're new here and if you're joining us now, let us know where you are joining us from. We'd like to know. If you join us in another webinar before, you know that we do this disclaimer all the time before we start. So we do not provide any tax, legal, or investment advice or structuring advice of any kind. We do not endorse any products, services, or investments of any type. And then all information here shared today is for educational purposes only. We encourage you to seek the advice of a financial attorney, a financial advisor, an accountant, or an attorney before you enter into any deal, okay? So that's very important there. Let's talk a little bit about what is a self-directed IRA and how is it different. Basically, a self-directed IRA is like any other type of IRA with the same rules, the same restrictions, the same contribution limits. The difference and the reason why we use the term self-directed is so that you understand that with this type of account, you're going to be investing in private investments, okay? Private deals or alternative asset investments is also referred to. And what do these look like? These are some examples of what that looks like. So real estate, for example, you can use your IRA or your 401k from previous employer, bring it over to a self-directed IRA, and you can invest in real estate, for example. Whether that's purchasing, a property for buy and hold and renting it, or maybe a fix and flip. Maybe you want to purchase land. You can do that with your self-directed IRA. You can also participate in or buy shares into a private entity, for example, an LLC. You can purchase cryptocurrency. There's also a really common and recurrent investment option that our clients do here at Quest, and it's promissory notes, whether they're secured by real estate or any other asset, or unsecured. Basically, loans that you can do off of your self-directed IRA and charge interest and grow your accounts that way. So these are just some examples. If you have any questions, or if you would like to connect with any of our great team here of IRA specialists, go ahead and scan this QR code and book a consultation with us. It's complimentary. So, you can go ahead and ask us any questions you may have, or, talk about what that looks like investing with a self-directed IRA. But without further ado, I'd like to bring Chris up now so that we can go ahead and get started with today's presentation. Hi, Chris. Thank you for joining us.
Hi, Andrea. Thanks. And thank you, Quest, for, having me back. I'll have to say, we'll dive in, but Andrea, you might be the only person who's excited to talk about fixed income. I'm trying to change that. I'm trying to make fixed income exciting, but we'll see how we do.
Sounds good. Take it away. Thank you.
All righty. Well, hello, everybody. One of the things that we will be talking about today is, strengthening your portfolio with alternative strategies. I'm going to do that a slightly different way. I'm going to start off with talking about a subject that a lot of people have probably actually, read in the news. What's this 60-40? Is it dead? I'm trying to get the time to write a small article that 60-40 is not dead. 60-40 is just a portfolio allocation. And really what people are getting at is the allocation and how is that impacting equities and fixed income. And so we'll talk a little bit about that. We'll walk through, we're talking about alternatives, but let's back up and talk what are traditional fixed income. And I'll walk through a lot of different events that are occurring, over the last couple of years and still today around, why private credit? Why is everyone talking about this? And then we'll talk a little bit about, private credit in real estate, which is nice. Andrea's and Quest do. It sounds like they have a number of different products in that space. So it's definitely something to look at. And then I'll dive into a little bit about what I do, microbalance bridge loans in real estate, and then use my fund a little bit as a case study to sort of support what we're going to be talking about throughout the rest of this conversation. And then we'll have some questions and answers. And I open up, if someone's got a question in the middle of any of this conversation, please put it in chat and I'll try to address it in a timely manner, especially if it's something that pertains to the slide we're on. All right, moving on. Is the 60-40 dead? No, the allocation of 60-40 is not dead, because that might actually be the allocation that is best for a particular investor, given a variety of different occurrences of where your risk aversion levels, your objectives, your required return that you're targeting, your liquidity needs. I mean, there could be a number of things of why 60-40 is still working. One of the things that people should be addressing is, well, what broke and what didn't? And it all came down to 2022, where we had one of the worst performing combinations between equity and fixed income. It's happened a few times previously, but 2022 was the worst time that I had seen in my 29-year career. So most people probably listening to this in your time frame as well, of having both equity and fixed income, have a negative return of double digits. And so I threw a little chart over here onto the side, just looking at a number of different indices. And in this chart, we'll use the MSTR levered loans to kind of represent private debt. It's kind of the go-to index for private debt, even though we will talk a little bit about different kinds of private debt and realize that that index is not always the best fit for something you might be looking at as an investor. So we can all look at this chart. What broke and caused problems really in 2022? Well, it's pretty obvious. Equity did not break. So the 60's not really dead. It's actually done quite well in a lot of different areas. Some better than others. We got to take a grain of salt that the S&P 500 has had a great return, even though very volatile. It's been led by, a very few names all in the AI space. But it's very clear what broke. And this is why we're going to have this call today, is fixed income broke. It wasn't something that really anybody ever thought about, because money was cheap and equity was king, and it was all about driving and being in the right equity to maximize your return for the risk you were taking. And it was relatively easy to do for a very, very long time. And then we all woke up and realized, wait, there is an allocation that we have in our portfolio that's this fixed income that generally, as I said earlier, is not terribly exciting. But it can actually get pretty exciting when you start to dive in, educate yourself about the alternative fixed income options. And we'll walk through some of those, later on. So you can see here, the broad indices for this time period that I'm showing here, 2020 to 2024, they're all negative still. It's going to take a while for that to crawl out, even at current interest rates that you can obtain in a number of different traditional assets. So, and I mentioned traditional assets. Well, what are they? Well, traditional assets, most of you may know, but just in case, you're going to go buy a mutual fund, ETF, or a direct bond that's, a corporate bond, treasury bills, bonds, and notes. Maybe a high yield index, something like that. Maybe the, J&K. There's an ETF out there that tracks a basket of high yields. Muni bonds. There's that's something that, in a number of states where they have income tax. Well, maybe muni bonds are a very viable option for you as an investor, because, that tax-free income has a pretty big impact to your portfolio. I throw BDCs, business development companies, and real estate investment trusts in here. I know there's some people out there that talk about them being alternative. I don't. If you're publicly traded, I really feel you're at the whims of the emotional swings of the market. And yeah, they do invest in private debt many of the times, but it's a very different instrument. You are investing in a C Corp that does have an asset class that might be considered alternative, But in my mind, if you really track those instruments, they function much more like your traditional fixed income and traditional equity investments. So I kind of threw them here in that slide. But that interpretation is up to you, how you want to do it. I know a lot of people who love BDCs and real estate investment trusts, so I'm not negating them. I'm just saying I kind of throw them in the traditional bucket because they do have a lot more volatility because they are publicly traded. Current state of traditional fixed income. Well, that we don't have enough time to dive into all of that, but let's just say it's been a wild ride. It's very, very dynamic right now, and we're not out of the woods. We've had the largest Fed raise in the shortest period of time in history. And that has set off a number of different things as they try to battle inflation, rising interest rates, new regulations on the forefront. There's just a ton of things, bank failures, going on and on. And I just wanted to show a couple charts here. If someone hasn't seen some of those, you can pull them up in a number of different places just to kind of see, well, where are interest rates right now? I mean, the U.S. Treasury versus corporate bonds versus, those are called credit spreads. If you've never really thought, it's like, hey, what is my spread over Treasury? Well, okay, I've got, a 2.8% roughly spread between a 30-year fixed rate mortgage and, the U.S. 10-year Treasury. So if you're not familiar looking those charts, that's how you would think about, well, for the risk I'm taking assessed by this market, what am I being paid? And then you've got the yield curve on the right there. Obviously, everyone loves the idea of what if I just go buy laddered treasuries and make 5%? I'm not saying that's not a viable option in a number of different portfolios. I've actually told some people that depending on their liquidity needs and their risk aversions, maybe that's not a bad play. It's definitely an option. One of the things I do want to state here is this current markets and all these issues that we're dealing with have definitely increased the correlations of traditional fixed income to a lot of other assets that people own, like equities. I'm not trying to compare. This is when you look at correlations, you're really looking at saying, I own a basket of investments. And if I'm going to add a new investment, does it diffuse risk within that portfolio? Am I adding a diversifier, or am I adding something that's going to be moving a little bit more lock in step? So if the market turns, you can see like the aggregate bond index, which if you're not familiar, that's run by Bloomberg now. It keeps on changing hands. It's a compilation of about 10,000 different bonds, all US, and it's used as sort of a broad indicator of, well, what is traditional debt, public debt, in relation to a number of things. So you can see there, and if you're unfamiliar with correlations, it's a scale from 1 to -1. The higher the positive number, the more those two assets move in conjunction as the market moves. And if they're negative, which we'll show some later on, where you can see the impacts of where some of the alternative fixed income instruments out there actually not only can be a return enhancer to your portfolio, they actually can mitigate risk. So they're not going to move lockstep. So other things, it's not a bad thing to own the S&P 500 or a US REIT or something like that. That's not what I'm saying. What I'm saying is if you already own those and you're going to add fixed income or adjust your fixed income portfolio, because that's obviously, what's been broken in that 60-40 allocation. Okay, well, what do we want to add and why? So to add traditional fixed income, well, you may not be adding the diversification you think you've historically been adding to your portfolio. So, and here we are. Let's take a look at, private debt funds. And this is one particular real estate fund. You can see that there are negative correlations. So what that means is if I invest in a private debt fund with a negative correlation to, say, my 100% S&P 500 total return index, let's say I only own one asset, well, this is not a bad add. It might, I'm actually probably, offering some level of liquidity aspects to the fund, but I'm also lowering the overall risk and the risk-adjusted return in that portfolio by adding that asset to the portfolio. So something to think about there. I know I'm throwing a lot at you, and a lot of this is some pretty heavy portfolio structuring. So, there again, as said earlier, by Andrea, go talk to your financial advisor. talk to about what they think about these things. And if you can't get an answer from them, you can always drop me a line. I love talking about portfolio structure and how to think about things. So I'd love that phone call. But you can see here, private debt does have a really interesting impact to an investor's portfolio. Let's change gears a little bit and talk about where's this all coming from? You can't really check the news right now without seeing something in private credit and some new private credit fund being created and some Wall Street fund deploying billions of dollars to private debt. It's literally everywhere, and you can see in this chart put together by Preqin, it's been growing for a while, but it is taking off in a massive way, and forecast to continue to grow for some time. And there's a lot of reasons that we'll talk about why they think that growth is going to continue. But the entire private debt area is now bigger than levered loans. It's bigger than high yield bonds. So we'll see. Hopefully we don't run into a problem of where it gets too big for its britches. Here's sort of a dateline for some of you who are less familiar with what's really occurred in private debt as well. In 2010, obviously on the back end of 2008, great financial crisis, there was a number of regulations came down, and they were put into an act called Dodd-Frank Act, which limited banks, from a lot of different types of lending and had a lot of risk control regulations put in place. We went through a very long period of time for a low interest rate environment. And then all of a sudden we had COVID combined with the battle against inflation from the Fed, rising interest rates causing bank failures. And we still have Basel III, which is a series of regulations that have already started to be implemented, but they're going to continue to be implemented throughout and up to 2028. So if you think banks are restricted now, there are more plans to restrict them, already in the books. And you can see over there to the right, the years of what's occurred since 2020, really, or actually 2010, you've seen, the share, according to numbers from Oaktree, the share of, loan issuances has collapsed for large U.S. banks. And so that's pretty drastic. And so and people think that's going to actually continue to move in that direction. Stated here, recent bank failures. Everyone's launching, as I mentioned earlier, everyone's launching a private credit initiative. And now you're looking at, JP Morgan, one of the biggest banks, is now dedicating more than $10 billion of its own balance sheet to private credit. There is no lack of interest. I just say, and this is sort of my own bias, you take it what it's worth. A lot of these big banks, they will step in and they will create, products that will earn a return. But when you're deploying billions and billions of dollars, you really kind of have to be doing the same thing that everyone else is doing. And so it becomes very crowded very quickly. You'll find that that's where the large pensions and endowments and everything else, they have to deploy their money there because they have to write very, very large checks. But you as individual investors really have a choice. You can certainly invest in a fund that's run by a large shop, but you have a plethora of other options in the private debt world that it's kind of funny. The big guys really can't look at because the checks they have to write are just too big for the small private debt spaces that are emerging pretty much everywhere. So it's a unique occurrence because most people always say, oh, the big guys always get the advantage and the small guy gets the shaft. And it's like, well, it's an interesting time to where the small investor, it will take time and education and you got to do your homework. But there is a lot of opportunities for you to greatly enhance the fixed income side of your business to where, you can be earning equity-like returns with debt level risk. And, the big guys won't be able to play at that level. So that's interesting times, at least, for me, because I always was the large allocator and couldn't really do some of the really niche idiosyncratic things because, well, I just had to write too big of checks and you had to pass on, smaller, interesting funds. One of the aspects that people are recognizing, and I said this is a good slide. You don't have to digest this entire thing right now. I'll talk a little bit, but this deck is totally available for everyone who's watching. This is talking about a number of impacts around, return and risk and how they would affect your portfolio. So, well, wait a second. You're looking at, I can actually, in direct lending, I can actually capture higher returns, with lower volatility than, say, levered loans or high yield bonds, and especially a number of other different traditional investments. And then they're looking at, well, okay, within high interest rate environments, which we are, we're in higher interest rate environments than historical. How about that? I wouldn't say we're in high interest rate environments, but in general, direct lending is outperformed from a performance standpoint. And then this chart actually shows some numbers where, even in COVID, where, before the Fed had raised rates, direct lending tends to be more defensive. Doesn't mean it doesn't lose. I mean, I think people get a little led down the primrose path a little bit of like, well, oh, you can go into private lending and it's somehow immune to a number of things. It's not. I mean, you're going to have foreclosures, you're going to have issues, there's going to be defaults. But in general, that just tends to be more defensive than a lot of your, levered loans and high yield bonds and, other instruments. So something to think about there, as it's certainly a unique instrument right now because you can add it to your portfolio and it increases return potentially and lowers risk simultaneously. So it's a nice double punch. This is a piece put together by BlackRock, and I just wanted to throw this into the deck and share. This is their 5-year outlook of expected returns and a band of uncertainty. So standard deviation around a set return. And I thought it fit perfect for our little talk today because even according to BlackRock, over the next 5 years, they've really put direct lending and private debt in the golden seat up there. So I thought that was something to really share and really bring to light for a number of people who are unfamiliar with the space. This is a time to definitely educate yourself, come up the curve on how you might want to think private debt fitting into your portfolio, because all the big research houses are recognizing, okay, this is going to be something, and it's going to be something for a while. The ride's not over, even though it really started, in 2010. And secondly, BlackRock put this together saying, hey, here's asset class by volatility, by risk. Now, there are certain things that are obviously less risky than direct lending, but you are looking at, if anyone has studied their efficient frontiers and understands, hey, if I was to run a regression on this chart, you're definitely looking at direct lending being way above that chart with a much higher potential return and a much lower risk than comparable instruments. So there again, something to think about as you add that portfolio. And that's why, a lot of these points is why people are flocking to this idea. This is why so many people are deploying money, because right now you are looking at an opportunity to really make fixed income exciting. It's something that no one ever really thinks about. Even myself, when I was managing people's money, it was always a real heavy focus on what stocks people were going to own, what kind of allocations they wanted in their equity side. And then we had some mutual funds and maybe a direct laddered portfolio and bonds, but no one cared. It was just something that was there to, if I needed liquidity in a pinch, it was lower volatility, and it kicked off some income if there was an income need from, a person's account or a trust. But now you really have the ability to swing a unique sword in, private debt and really make your fixed income portfolio, really perform for you and really, earn, an outsized return. And you can see here in this chart, 90% of investors they're super happy with what's occurred. These are all, Preqin's numbers, so there's a mix of family offices and institutional investors and individual investors in these numbers. So you got to remember kind of what you're looking at. Obviously, the institutional investors will have a bend because they're usually much heavier in alternatives than your individual investors. But they've realized one key thing is this is a great time to be looking at this space, and it can definitely affect the portfolio for the long run. 51% of investors intend to increase commitments, and then this number, the last number, is a little confusing, but it's pretty interesting to see that 40% of the people have already increased, and they're going to maintain the amount of capital in play in private debt. So it's a pretty sticky place that people have been happy with. They're looking to either grow and certainly maintain. So if it's something, you're looking at your allocation and talking to your financial advisor, well, is it something you should add, given the different return profiles? Because a lot of your financial advisors might be looking at something that's going to return, 6-7%, and maybe that's not a big enough impact. But what if you found something that's going to return 9, 10, 11 that you can add to fixed income, and it might be a pretty stable, consistent return? Well, that might change the math behind how you think about your allocations. So I just wanted to go over this real quick. Private debt is a very vast space. You've got venture debt, you've got personal loans, you've got peer-to-peer lending. I mean, that's what Quest was talking about earlier. Is like, hey, you can do a direct promissory note, often backed by real estate. You got private consumer debt. You got private business loans, collateralized loan obligations, better known by some people if you know the acronym CLOs. There's entire funds that invest purely in CLOs. Distressed debt. There's a lot of talk right now of, well, can I come in and pick up distressed debt to take over certain equity positions in properties? Can I buy this distressed debt at a discount? There's definitely a trade there. But in all of these, it's always a buyer beware. Be sure to educate yourself, get the proper information, build a network that can help you answer some of those questions, because the due diligence, although there is similarities between all these classes, there's some differences as well. And so you really have to understand, what are we looking at? And lastly, private credit in real estate, which is obviously something, is near and dear to my heart. It's something that I know there's been a lot of people very interested in that space. And why? Well, okay, let's see. You can capture an excess yield over traditional instruments. You can get diversification benefits. It's generally found to be, have low correlation to traditional assets, as we discussed earlier. And one of the big ones is, well, you have a real asset supporting your loan. And there's a lot of metrics that we're not going to have time to dive into to understand, LTVs and valuations and everything else that goes in. But the key aspect is there is a real asset supporting the principal value of your loan. And that is where you get into principal preservation aspects. There might be a clear path to principal recovery if something goes wrong. And if you think nothing's going to go wrong, well, you're fooling yourself. Someone told me it's not a matter of, if, it's a matter of when. I mean, so you want to, whatever you're doing, build a diversified portfolio of it, or, invest in a fund that builds a diversified portfolio for you. I know a lot of private lenders that have closed up shop because they've realized, I'm going out there and doing 2 or 3 loans. And if one of my loans goes bad, well, that's 33% of my portfolio. I need to be with somebody who can run, 50, 60, 70, 100 loans, if not more, to create diversification, because, things don't always work out as planned. As I talk here, diverse terms, allowing mitigation of risk. So there's lots of things that go into the underwriting aspect and putting loan documents. Good questions for any manager you're looking at investing in. And now to take it down to a next level of even, further diversification, in the space that I operate in is microbalance, bridge loans. Bridge loans are a short-term loan given for someone who needs to purchase or a refinance opportunity on an existing property that they may already own. We have found this to be a very fragmented and inefficient space. You got limited access to deal flow. We've been doing this for about 4 years, and we're very fortunate because my partner that we teamed up to build our fund, he had already built a number of different networks to access deal flow. And we continue to build those. But to just jump in and say, hey, how do I find microbalance bridge loans in the commercial real estate space? it's not easy. Now, one of the interesting aspects of what makes this fragmented and efficient is there's minimal supply of funding to your smaller markets. Like I said earlier, you as investors have this access to maybe smaller niche markets that the bigger guys just can't play in. And these smaller markets, why they're really unique is, well, the big money from Wall Street and even, billion-dollar funds, they can't come down and write 400, 500, 600, maybe even $1 million loan. It's just too small for them to be, it's de minimis to their portfolio. So you can find smaller operators that can really step into this space and, capture those inefficiencies and really create a repeatable, excess return, hopefully beating your fixed income, expectations. So here's a little case study. This is the fund that I run. In microbalance commercial real estate bridge loans, it is a pretty big space. It's hard to get exact data because no one really tracks to that small of a level, which is a good and a bad thing. So when you go to the big data feeds, they kind of have to aggregate up to a pretty big loan size because they just don't break down the micro markets. And so that may be frustrating to some degree because you're like, well, how big is my market really? But it's also a good sign of, well, bigger shops that really need to have that right data and they need to understand, the size, or they're looking to run $1 billion, $2 billion, $10 billion fund. Well, they're most likely not going to look at this space because they just can't understand their market size. But, if you're running a smaller fund and really targeting this niche, it's a great place to hunt. And, according to, LoopNet and CoStar and everybody else, they kind of came up with this broad, space of 223 billion, which that's a big market space. You could actually have a multitude of different operators in this space and they may never even see each other. And what we found and what we knew why we started this is, well, there again, other lenders are just not lending consistently in this space. There's a few people I know that are looking at this space, since we've been in it and brought it to light. But we haven't found anybody yet who's like, I that's what I do all day is 100% of my portfolio. And then those are the inefficiencies. And you'll hear me say this if you watch any of my other webinars. The other side of that is, well, the edge, does the team have a long history, in running funds, underwriting real estate? You do your homework is what this slide's really about. And so understand the inefficiency and edge. And there's a lot of, opportunity in microbalance commercial real estate. I'm not going to dwell too much on this. The key aspect is, pretty consistent, stable returns is what you're looking for. And it can be achieved in small niche spaces, So this chart, we blew this out so it looks like there's some kind of difference, but you're looking at that's rotating between 80 and 100 basis points. So that's only a 20 basis point differential spread from month to month. And, if there's any, questions, the chart that I showed earlier was just looking at kind of like, hey, what happened down here with bonds and this, and we didn't have any private debt on it. I threw the numbers that we actually track for our own fund and that our fund administrator tracks. You can see private debt can really create some really interesting profiles in your portfolio where you can actually produce really great returns on a trailing basis. And so just so anybody knows, all these numbers are based on, an annualized number for this time period of April 2020 to February 2024. And you can take very low risk. Doesn't mean there's not risk. Doesn't mean you won't have dynamic markets that, like we're in like right now, where there might be more occurrences of defaults and extensions and refinances and things like that. But overall, in a diversified portfolio, it stays pretty stable. And that's where you got to come in and really understand that manager's edge when you're doing your due diligence. And that's all I have on, private debt. Hopefully I made it super interesting and something for you guys to now consider and think about, okay, how do I, work with my custodian, or how do I identify funds, or what network do I need to go into, and, think about adding this to, your portfolio. So if there are any questions, please fire at will.
Excellent. Thank you very much, Chris, for that. That was really quite interesting. to see. It seems like we have an awfully quiet crowd today, but maybe maybe they'll come in with some questions here in the next couple of minutes.
Oh, I find sometimes some of these, it's you have the recording, you send it out, and everyone watches it, later in the evening, and then comes back with a ton of
Yeah,
questions.
and then
That's really what we've seen in today's age.
sometimes also, it's a lot of information that you want to kind of digest first, and then you'll think of something. Hey, I'd like to know this or that.
It is, and I definitely covered a fair amount of portfolio structuring, how fixed income fits into it, and hopefully created a lot of opportunities for people to sort of sit back and think, what do they want to add to or change. So
For sure, I do want to go over a couple of promotions that we have before we
certainly.
close off, and also to give some time for people to see if they have any questions. So let me just do that quickly. We'll bring you back up in a second, Chris. Okay. So again, very interesting what Chris is saying, and a lot of our clients do invest in private loans. So that's just really cool to see there how well that's performing and how that's kind of going up. And so yeah, if you guys are thinking of establishing an account with us, right now we have a really good promotion before tax filing deadline, which is April 15th. Next month, you can use this code and open an account for free, or 2 or 3, how many accounts you need, you can open them for free with this code. So make sure you use this, maybe take a screenshot or share it with someone who you think might benefit, or who's thinking of opening an account, so they can benefit from this code. Okay, we typically charge $100 to open an account, so that'll take care of that. And it also comes with another good feature for our Quest Expo, which I'll talk about in a second here. That same code, so keep that in mind. But first, we are having self-directed IRA social in our Austin, Houston, and Dallas offices in person. This is going to be in May. We're already, registration's already open. Make sure to join us for this one if you can. It's going to be a great time, as it usually is, for networking and for finding your next deals. But we'll also have some really good speakers on it as well. So make sure you register here using this QR code and join us there. We'd like to see you for sure. Now that our socials are quarterly, we kind of miss seeing people here in the office. And then finally, last but not least, the Quest Expo. So with that code, that the tax-free 24, you'll also be able to get $100 off from the Quest Expo ticket, general admissions ticket. So that's a huge deal too that we're promoting right now. If you're thinking of opening an account, then you'll also be able to enjoy this this promotion. Another $100 off, so you'll be saving a total of $200. So yeah, we're really excited about the Quest Expo. Make sure you check it out. If you have any questions, reach out to us. We already have the agenda. We have most of it already set up, so you can definitely take a closer look at how great it's going to be this year, June 27th to 29th. So it's approaching really quickly here. Let me add Chris back. Hi, Chris. So no questions. So I'm assuming, people are going to reach out to you. I'm going to put back your slide here. If you have any questions for Chris, guys, go ahead and reach out to him directly. Or if you have questions for us here at Quest, we're also always here for you whenever you want to reach out. But I want to thank you, Chris, for coming on today and talking to our audience here. And hopefully we'll have you again soon in the future.
Oh, definitely. Well, no, I appreciate it. Thank you. And everyone, thanks for attending, and we'll talk to you next time.
Awesome. Thank you. Have a great afternoon, everybody.
Cheers.